Hi there, my name's Edwards from Edwards of Gwynedd, Chartered Certified Accountants based here in North Wales. I'm going to be doing a quick video today on a question I get asked a lot about, which is what's a limited company and is it worth me looking to open a limited company? We're going to briefly discuss exactly the ins and outs of what a limited company is and how they work, and also we'll look at the pros and cons, and hopefully by the end of the video you'll have some sort of idea on whether a limited company is right for you. So essentially there's two main types of limited companies. There's companies limited by shares and there's also companies limited by guarantee. We'll be looking at companies limited by shares today. They're the most popular company. You might have also heard of PLCs. These are larger limited companies that are traded on stock exchanges such as London Stock Exchange. But we'll be considering just smaller companies such as those that are limited by shares. So what is a limited company? Essentially, a limited company is a separate legal entity to yourself. You might think, well, how does this differ from being a sole trader? So as a limited company, you will have two roles within this separate legal entity. You'll be a shareholder, that is, you'll own the shares within the company, and you may also be a director, that is, that you're an employee of the company. The company will trade separately to yourself. It's its own business. From the shares, you'll be able to draw a dividend if the company's made a profit, and you'll also be able to draw a wage as an employee of the company. So that brings me on to how the company will be taxed. How is it taxed differently to being self-employed? The company itself will be taxed as a company using corporation tax. You will be taxed under the personal tax regime. So you'll be taxed on whatever monies you draw out of the company. So you'll be taxed on your wage if your wage is high enough, and you'll be taxed on any dividends that you draw from the company. So other ways of getting money out of the company would be through pensions. You could set up a company pension scheme whereby the company would pay a pension on your behalf. It's quite a tax efficient way of doing things. You can be repaid any business expenses that you've paid privately. The company should reimburse you for these. Moving on to company assets, this is another thing to think about. The company itself will own all of the assets. Even though you might own the company through owning the shares within the company, all company assets are actually owned by the company. So the company will need its own bank account. If it's got a car, the company will need it. The company will own its own car. And if you decide to use any of the company assets, such as the company car, for your own private use, then you'll be taxed personally for doing so as a benefit in kind. So what are the pros and cons of a limited company? First off, historically, having a limited company when you're earning over a certain level has been a very tax efficient way of trading. You've got the flexibility of different ways that you draw money out of the company, the ways that I previously mentioned, and using different ratios can really reduce your tax liability. Secondly, we've got one that is really important to a lot of people out there, which is that you'll have limited liability. That is, whatever you put in to the shares, however much you pay for the shares, your liability will end there. If a company came to try and sue your limited company for a large amount of money that the limited company didn't have, the liability generally stops with the company and they could come after any of your personal assets. Also, it can be easier to grow and possibly sell a limited company. You could even half your share within the company and maybe sell half of it, break it down. It's easy to split up a limited company. It's also it's easier to restructure a limited company, for example, by having different types of shares and setting it up. Maybe within your family, if you wanted to give certain people shares, it's quite easy to manage and adjust the ownership of the company. It's also got more of a sound legal structure. So within the Articles of Association, there'll be certain rules and regulations that everyone's got to adhere to, and it's all down in black and white, whereas a sole trader, you'd have to get this really set up through a solicitor. Finally, it gives you a little bit more credibility, when perhaps investors or possible clients or customers are looking to use you. People generally tend to see a limited company and feel that you're a substantial business. So what are the cons? Cons, well, there are more rules and regulations. You can't just go to the bank account and dip in and take out the money as if it's yours, because as I previously mentioned, it's a separate legal entity and you don't actually own the money within the company. You've got to draw it out of the business in one of the ways that I previously mentioned. There are penalties for not running a company properly, so it is always best to run the company as it should be. There are higher accountancy fees. There's more work involved for accountants. You've got to do two different types of company accounts, abbreviated accounts generally, and also main limited company accounts. You've also got to report to Companies House, do a company's tax return and a personal tax return. It might be more difficult to lend money if the company's just starting up and it hasn't got a huge amount of profits and money's within the company. Then it can be more difficult to lend money from the banks. So I've gone through all my points there. There's a lot to consider and some things that you should definitely discuss with your accountant if you think that it might be beneficial for you. That's all for today. Thanks for listening and have a good day.